So we've all been in this position of wanting to buy a stock, but the price is too high, right? It's probably gone on a recent run, it's gotten away from us, and we're sitting there thinking, gee, I'd buy this thing if it took a dip, if there was a pullback, I'd be able to get a better deal. So this is where put options are a really, really great choice. They actually enable you to buy that stock on the dip if it happens, and if it doesn't happen, you can actually earn some income while you wait. So it's kind of the best of both worlds in that way. Basically, you can get paid extra for doing something that you would have done anyway. How's that not a good deal? So let me tell you how to do this. Okay, first up, you have to understand what a put option is, and bear with me, this is kind of a difficult topic to explain in a video, but I'm going to do my best. A put option is basically a promise that you make to somebody else to buy stock from them at a certain price. Let's take a look at this as an example with Apple. So I put together this very simple example based on current data. Actually, as of yesterday, Apple was trading around $127 a share. So what I could have done is I could have written this put contract and sold it on the market. And basically the terms of this contract say, look, Apple is trading right now at $127 per share. I promise to buy 100 shares of Apple from you, the person who buys this put, anytime on or before February 19th for the sum of $120 per share. You will now pay me $510 for this contract, and that's totally non-refundable. So these are basically the terms of this agreement. And so if you look at what's happening here, you are committing to the buyer of this contract that you will buy this stock at $120 no matter what. Now, I think it's easier to understand this if you actually look at it from the point of view of the person who's bought the contract. They're buying an insurance policy against Apple falling below $120 by a certain date, February 19th in this case. And essentially, you are the seller of this insurance policy. You're basically in the insurance business at this point, and you're collecting a premium, that $510, from the person who buys your insurance contract. Now, there's a few definitions here that are important. Basically, the $127 is referred to as the current price of the underlying, or the underlying stock in this case. The date of February 19th is called the expiry date of the contract. And basically what that means is that when that date rolls around, this contract is worthless. It's gone, it's torn up, it's as if it never existed. So any action that the buyer has to take on this contract needs to be done before that date. And that $510 is referred to as the option premium. Just like an insurance policy, it's the premium that you collect in exchange for providing this insurance to this other person. And so boom, you're now in the insurance business, which is pretty awesome. We all know how much money these guys make. So now let's take a look at what can happen as this insurance contract of yours plays out. So I'm recording this video on December 20th, so we have about a month to go until expiration. So between now and then, what can actually go on? Well, one scenario that could happen on expiry is that Apple could either stay where it is or go up from here. And basically, if Apple trades anywhere above $120, which is the strike price, as they call it, of this particular contract, then basically the contract is canceled. I'll keep the $520, nothing else happens, and that's it. That's the simplest possible case. And so as the seller of this contract, that's kind of what I'm hoping for here. I'm hoping that Apple actually stays the same or goes higher, and I get to collect all of this premium. That's the ideal scenario. Now, if I actually wanted to buy Apple stock on that dip, I might actually be hoping for it to go below that, and that's the next scenario we'll take a look at. So this is called assignment, where the holder of the put option actually decides to assign the stock to you, the seller of the put contract, at the strike price. And this would happen if Apple fell to below that $120 mark. So let's imagine what would happen if Apple actually fell to $115 and it was trading there on February 19th. The put buyer is absolutely going to exercise his option at that point, and he will force me to buy 100 shares of Apple at $120 per share. Now, the stock is trading at $115 and I had to pay $120, so I immediately have a bit of a loss on this position. But remember, I got to keep the premium no matter what. So yes, I'm taking a $500 loss on the shares, but I still have $510 in premium. So even though the stock went quite a bit below that $120 strike price, I'm actually still a tiny bit in the green on this one. Plus, I actually own 100 shares of Apple stock. Now, it's the second scenario where this one goes significantly bad, and this would be an example of the trade turning against me by a fair bit. And this would happen if Apple falls a fair distance below that strike price of $120. Let's say it fell all the way down to $100 and it was trading there on February 19th. Again, the put buyer is going to exercise his option. I'm going to be forced to buy those 100 shares at $120 per share. So I'm now paying $120 for a $100 stock. So I'm basically taking a $2,000 loss on those shares, but remember, I still have that $510 premium that I collected way back in the beginning, and that's still sitting in my account. That's going to mitigate this loss a little bit. So now basically you can think of it as owning Apple for a net price of about $115. This is the difference between the $2,000 loss and the $510 premium. It sort of gives me an effective price on this Apple stock at around $115 at a time when it's worth $100. So did I take a loss? Yes, I paid more than I otherwise could have for the stock. So what's the upside to this strategy? Well, really it's all about earning that option premium while you wait for that stock to take a dip. And this is especially appropriate for stocks that you want to buy anyway, which I mentioned in the beginning of the video, because you kind of win either way. If the stock actually stays the same or goes up, you get paid in terms of option premium to sit there and wait, which is fantastic. That's money that you otherwise wouldn't have gotten. If the stock takes a dip and has a pullback, you will buy the stock at that lower price and you get to keep the option premium. So again, this dip is still a win scenario for you. You only have a potential loss scenario if the stock really, really plummets. And I think you have to compare that bigger loss scenario to what would have happened if you had paid full price for the stock. So remember, in our example, Apple is trading $127 today. If you really wanted Apple, you could have in fact gone in and bought it for $127. Now fast forward to the future where it crashed down to $100, your loss is actually $27 per share. In my example here, using the put option strategy, my loss only went from $115 down to $100. So if you compare this to the potential loss of an immediate buy, it's actually a little bit less, which to some extent makes this strategy a good deal less risky. So what you could do is you could manipulate the strike price and the expiry date to give you either a higher or a lower chance of being assigned that stock. And so for people that really do want to buy Apple on the dip, they could absolutely structure the deal in that way. If you're on the other end of the spectrum, however, and if you think to yourself, well, yeah, I wouldn't mind if I bought Apple stock, but really what I'm interested in here is collecting the premium, and I'm actually fairly bullish that Apple is going to drift higher or stay the same, then you would set up the deal to give you a higher chance of collecting the premium and not being assigned the stock. And this is all very, very easy to tweak using the parameters that are available to you in these different options contracts. It's all up to you how you set up this deal. So what's the downside risk? Well, there's a lot of it comes from not understanding these strategies, and I think this is where options get a bad name. There's a lot of traders that dive into options trading, which is inherently complicated. There's a lot of things to take into account, way more than I'm actually covering in this video even. And so I think people will dive in, they will get involved in these more complicated option strategies, and they'll end up losing a lot of money. Options use inherent leverage in margin accounts, and I think traders can often get caught out by this. So I think the way to deal with that risk is to get started with very simple strategies like this one. This idea of selling puts against stocks that you would otherwise want to own anyway is very, very low risk. Another thing to consider on the risk end of things is you have to look at how many of these put options you're writing on how many different stocks. So what happens in a market downturn is a lot of stocks will all dive suddenly all at once. If you have a lot of open positions on options contracts, you risk being assigned on a majority of them, if not all of them. So you always have to look at the number of these that you have out there and think to yourself, if there's a black swan event in the market, I am absolutely going to get assigned on all of these. Can I handle that? Do I in fact want that? Now, if you're a value investor, if you're the type of person that likes to buy when the market takes a dip, you may be perfectly okay with that, and that's cool, but make sure you understand the math involved in terms of the expansion of your margin commitment if you actually got assigned in all these positions. Suddenly you're going to have a lot more money invested than you did just before. So speaking of losses, there's a picture here that I want to show you, and I did this just to kind of illustrate what it's like being in this business of selling option premium. And to my mind, it's exactly like the business that these big insurance companies are in. If you think about the business model for an insurance company, they collect small amounts of premium over a period of time from many, many people. But every once in a while, something really bad happens. Forest fire, flash flood, natural disaster, some kind of thing happens where they have to pay out a lot of money. And so the size of their loss is enormous compared to the gains that they were making on those small little bits of premium in the past. And then go forward, they're going to go back to collecting these small amounts of money, and then boom, massive loss again. So you have to kind of head into this strategy knowing that this is in fact what's going to happen to you. You are going to make many, many small gains interspersed with just a few big losses. And when I say losses, I'm going back to this example in Apple stock where you could potentially pay more than what the stock is actually trading at, and then you suddenly own stock with an unrealized loss. Now, if you're a buy and hold investor, maybe that doesn't concern you all that much, but it's a loss nonetheless. And you have to understand that that's the nature of this particular strategy. I think many people, when they hit their first loss, they look at the size of the loss compared to the size of their average gain and think, well, this is ridiculous. Why am I even doing this? I'm out. As a Canadian investor, I want to buy US dividend paying stocks for diversification. I hate the idea that I'm overly concentrated in the Canadian market. I want to buy these dividend stocks in the US. The problem is I'm a taxable investor. I hold these things in a taxable account. And so any income that comes to me from American stocks, it's taxed at a very, very high marginal tax rate because it's foreign sourced dividend income. I'm not able to get the qualified rate on dividends that American investors can get, and these also don't qualify for the eligible dividend tax credit in Canada because it's not a Canadian company. So while I want that dividend income for diversification purposes from these American companies, I don't want the tax hit that comes along with it. And so that's why options selling is a fantastic strategy for this. By selling options against this stock, any option premium that I make is taxed at a capital gains rate, which is much lower. For me, it's about 27% versus double that on foreign source dividend income. So by using this strategy to collect income from dividend paying stocks in a slightly different form, I'm actually halving the amount of tax that I would pay. And over the long haul, that's going to magnify my gains by a lot. Now, maybe you're not in this specialized situation. Maybe you're an American investor that just wants to use this to earn some income against stocks that you'd otherwise want to own. That's fantastic. Maybe you're a Canadian investor. Now, maybe you're not in this specialized position. Maybe you're just in the more general point of view of wanting to buy these stocks for whatever reason, and you're looking to collect some extra income. It's still a fantastic strategy for that. And also, I think that everybody needs to always have this watch list of potential buying opportunities, either adding to a position that you already have or completely new positions that you want to open. You always want that list of things that you're ready to buy if you're given a buying opportunity. And you should never chase the price on these things. You always want to wait for a better deal if you can get it. And this is where this strategy comes in. It allows you to get paid while you're waiting for this better deal. Now, this is even more important, I think, for a dividend-oriented investor that's looking for income. And the problem is that if you pay too much for a stock, your yield is going to be lower. And I have an example here to take a look at this. So let's imagine that you had $25,000 to invest. And you were looking at a stock that's trading at around $30 and maybe it pays $1 annual dividend. So the yield on that stock is 3.33%. So if I dump 25 grand into this stock, I would be making an income from it of about $833 a year. Fair enough. Now, if the stock price goes up to $33, however, the yield immediately drops to about 3%, and I would only get paid $750 a year if I had paid $33 for this stock. So as a dividend investor, I'm maybe a little bit less concerned about capital appreciation and price, and I'm more focused on the income. If that's the case, you can see why it's really, really important that I pay as little as possible for this stock, because that's going to maximize my income and my yield go forward. I think it's particularly dangerous for dividend investors to chase a rising stock price or overpay for a stock. You need to be really, really conservative on the price you're willing to pay so that you can maximize your income. This is also well suited to dividend investors, I think, because dividend stocks tend to have less volatility. They're larger companies. The options market in them is very liquid. There's lots of what they call open interest or volume in that option market. And especially for Americans, I think it's really, really easy to get into that options market, and the spread that you pay on options for these large dividend paying companies is really, really favorable. The options market is not good in Canada. It's a complete disaster, in fact, in terms of liquidity. It's really, really small, and so this strategy is much harder to employ in Canada. But for American stocks, either for American investors buying American stocks or Canadians that are looking to invest in American stocks, it's a really, really good way to go. Now, of course, by selling option premium on these larger, stable, more conservative, less volatile stocks, you're going to get less option premium. You know, the market is not willing to pay for an expensive insurance policy against something that has a lower chance of declining. So you're not going to get a ton of income by selling that option premium, but you're taking on less risk at the same time. And again, your risk is lessened even further if you're willing to own the stock on the event of assignment. So there's a couple of other things to consider if you're looking at this strategy. Number one, like I said, is make sure you really understand options trading before you get into it. That's important. Number two is you need a margin account to do this. You cannot do it in any sort of tax sheltered account because typically margin is not allowed in those kinds of accounts. So if you're in Canada, RRSPs and TFSAs, and if you're in the US, those tax sheltered accounts, they don't allow this sort of margin trading. There are some edge cases where it's kind of allowed at certain financial institutions and brokerages and things like that, but those are fairly specialized. For the most part, you need to do this in a margin account, in a taxable account. And so the process for opening a margin account and becoming eligible to actually trade options at any given brokerage is variable. There's a bit of a process to go through to become approved for options trading and for a margin account in general. And I don't want to get into that in this video. The process varies so much by broker, but just be aware that you're going to have to jump through some hoops to get this kind of thing set up if you haven't done it already. And while you're comparing brokers and the actual capability to trade options at a given brokerage, make sure you understand the fees that are associated with commissions on selling options and any assignment fees that the broker might charge. That's gotten way better in recent years. There's lots of really, really good brokerages, especially in the US, where you can basically trade options for free. So definitely research and take advantage of those. So guys, this is meant to be an introduction video to this basic concept. So it's kind of part one. If you want to see part two, where I would go into more specifics on how to adjust these trades, how to roll your options, what to do if you do get assignment, there are ways to actually get out of it and to sort of minimize the impact. There are ways to employ this strategy in the long term. So if you want a part two that covers those kinds of things, give this video a like, let me know in the comments, and if there's enough interest, I will absolutely do a part two. But in any event, if you haven't subscribed already, please hit that subscribe button. Don't forget to ring the bell, and I will see you on the next one.